Thank you, Puneet. We're coming to the fag end of the day. I don't want to take too much time and maybe keep more time open for questions. So this is the house of GPS, as we call it. At the bottom is the value system. We didn't get a chance to talk about it, but do please assume and believe that that's something we are working on. You must have been hearing some sounds while you were here. We are having a Champions Award night tomorrow, and there we will be, obviously, one of the things we're doing there is obviously awarding the employees who have demonstrated values, behavior through the last 1 year or so. We are again obviously doing it after a period of 3 years. But if you look at the rest of the house, it is about delivering world-class experience. We showed you that. We talked to you about Bharat Banking. We talked to you about the lifting the growth trajectory across various parts of our businesses. I'll very quickly cover Citi acquisition. We have in each of the businesses have talked about Citi and how is it going, but maybe I'll just give you a quick update on where it is. And on the profitability side, Puneet just revealed all the good news, so I'll just leave it there. And we also covered extensively the leadership on digital technology and data analytics. The message I want to leave with you is that we are lifting our growth trajectory now across all our segments. Puneet talked about the identified segments. As our NIM and our journey on NIM settles down, as our journey on cost to assets starts moving in the right direction, which it has, slowly, gradually, the ship is turning around. We need to obviously get the growth trajectory back up, and which we are working towards. Okay, let's change that. Sorry. Did I do 2 slides? Sorry, apologies. As we said, we lifted the growth trajectory. Puneet talked about the SME mid-corporate SME book, which is up 28%. Domestic subsidiaries, profit up by 51%. Retail advances, CAGR of 17%. And we also talked about how Connect and Grow will continue to deliver growth for us as we move forward. So broadly, we are heading in the right direction. Citibank, we acquired at a certain price because we believe it's a large, affluent, and profitable customer franchise built over a period of 120 years. It gives us access to a granular deposit base. 85% is CASA. It will lead to a 200 basis points movement in our CASA ratio. It's the businesses which are acquiring are complementary and strengthen our position as a top 3 credit card player in the industry. Will mean 41% increase in credit card advances and 28% of cards in force. Our wealth management franchise, I think all of us have talked to you about it. 53% addition to Burgundy Private AUM and 41% to the total AUM. We believe that we shared a pro forma with you when we announced the transaction in March. It was based on a pro forma P&L of Citibank and had some cost saves in it. We have also obviously continue to work with them through this time. It has significant potential for revenue and cost synergies. And we are hopeful that most of the leadership will transition to Citi and will obviously add to our leadership pool also. Please be aware of the fact that in that pro forma statement, we also talked about some transition costs which will incur, and that number has not changed. So I don't want to set wrong expectations here. As far as digital technology and data analytics is concerned, we covered all of that in great detail. Already we are ready with close to 10 crore offers. For 5 crores is for existing, and the balance for new customers in the universal underwriting relationship initiative. We have talked about the consolidated ROE, CET1 and all of that. And we talked about digital spurge and Bharat Banking. I just want to spend 2 minutes on, I talked about 4 steps in the ladder, and I think that's the message I want to leave with you. We flexed first, we moved towards excellence, we have launched a number of transformative projects across the bank, and you saw the results of that coming through in various businesses of ours. We are now aiming to start achieving leadership position in various businesses of ours. Our ranking has started moving up. Credit cards, merchant acquisition, Burgundy Private, what we've done on the wholesale side is an example of that. And as we showed you, a number of our initiatives, which are multi-year initiatives, which have impact on almost every business of ours, starting from Spurge, Bharat Banking, what are we doing in Digital 2, what are we doing in Bharat, what are we doing in terms of Connect and Grow, partnerships, the amount of money we're spending in technology, the kind of stuff which we are doing on universal underwriting, what we're doing with, say, an app like Siddhi, and stuff of that nature. By the way, we have not showcased everything to you. We have showcased some of them. We could actually demonstrate something tangible, and you got an opportunity to see how it is actually working when you went and looked at the screens. We believe it will have a multiplicative impact on our ability to continue to increasingly become a dominant player in the identified businesses. It will not end there. It will feed to every business of ours over a period of time. And our confidence that, yes, this will allow us to continue to gain share through identified, again in identified segments. And if you remember, when I did the presentation in the morning, there were these 5 bars on the right-hand side where our market share is way over what our traditional market share on advances and deposits seem to indicate. We will see more and more bars on that side of the graph over a period of time, and that's where the confidence comes from. You also got an opportunity to interact with our management team, both in Axis Bank and various subsidiaries. I'm sure you will have time to do that even further if you want. If you want to interact with them further, please do go ahead. But Axis has now reached a stage where most of the kind of the hard work in terms of the putting basics in place is done. Incremental benefits have come in. Now we are waiting for the multiplicative benefits to come in, and I think we have given a glimpse to you in terms of how it will flow, why it will feed into each other, and why we are confident that it will happen. And in many cases, I'm sure you're also realizing that a lot of the banks are not even talking a language of this nature. So let me just stop here. The entire team is here and at the back, so if you have questions, very happy to take it. Thank you. Questions, please. Don't take it? Sorry.
Yeah, we can have the question, please. We have all of them from this session. Yeah, please, Saurav, go ahead.
Hi, Saurav from JP Morgan. So 2 questions. One is on your deposits. It's not a question on you, it's for the industry as well. So we're seeing retail deposits slow down. Do you think there's a risk that, given you've not added branches over the last 3 years, the slower retail deposit then feeds into slower advances growth into next year? Do you think that's
so we have firstly added 700 branches in the last 3 years. It's not that our branch expansion pace did slow down. If you recall, 3 years back, we said we'll add 350 to 400 branches. It did slow down during COVID. We are now back. I mean, last quarter we did not add. It was more of a logistics issue rather than we slowing down. You will see branch addition picking up again in this particular quarter. So we are not shying away from adding branches. But yes, we are not adding at the pace at which some others are talking about. Our pace of branch addition will continue as it was during pre-COVID times. We're just being a little bit deliberate about it. We'll keep adding. The size format of the branches will change. Now coming back to your deposit side, yes, if our deposit growth continues to lag behind, it will ultimately have an impact on asset growth. It's a given. So yes, we need to get the deposit story right. We are fully aware of it. I think you're seeing some green shoots. It was there in Ravi's presentation. We have to work hard. We have to ensure that some of these green shoots become many more green shoots and we actually start pushing the deposit number up. Can we get there? Please understand, we showed you in rural, for example, in Bharat Banking, they were underrepresented. We showed to you that when we go to a district-wise market share, the number of districts where our market share is lower than 5%. We showed to you that yes, Triumph has had a positive impact in some areas, but as we replicate it across other parts of our customer segments, it can have a huge impact. All the other things which you're trying from a multiplicative factor perspective, if you add it all up, they're all fitting into deposits also. So yes, the confidence is there. It's a hard journey because the deposit growth in the system is down. But can we get there? Yes. Because brand is not a problem. No one is shutting a door on us. We have a pretty good name out there. People are not a problem. I think the quality of people is the same. It's just a question of being in front of the customer at the right time and offering right solutions. And if you keep doing that consistently, the deposits will come. There's no rocket science which some others are doing which is allowing them to do better. I think they're just at it. They have been at it longer than us. We'll get there. As we've got there in a lot of other businesses.
Got it, sir. The second is essentially on, you said that this performance should be sustainable here on, but this is basis, well below normalized credit cost. So as the credit cost basically normalize in forward years, so obviously there's about 25 basis points on OPEX you can probably draw down. What other levers do you think you have to?
So we delivered 18.9%. Boss, give us some credit. It can go down to 18. I hope you'll not kill us if it goes down to 18 one day. Not that we intend to take it down to 18.9. So firstly, there is a margin of 0.9% right there, right? But no, you rightly pointed out that there is some flex which is available to us in terms of the fact that there is work to be done on the cost to asset side. There is some flex available to us in terms of ensuring that we can bring down the cost of deposits also. So I don't know what more we can do in terms of NIMs. Credit costs are a historical low. They will move up. It's a matter of time. Right now, people are saying we are in great times and this is the lowest credit cost we have seen. But ultimately, we have to be prepared that as we continue to grow and continue to grow in a certain way, especially in some of the segments which we identified, the credit costs will move up. And that is why the question you have to ask yourself is this: as a franchise, what are they really up to? Are they executing on the day-to-day stuff? Is that a tick in the box? And do they know what they have to execute on? Are they thinking 3, 5, 10 years down the line, and are they putting some things and they already started investing in areas which could give you a return 3, 5, 8, 10 years down the line? And I think we try to show to you what some of the stuff which we are doing. We have not showcased everything to you. We showcased some to you because we have something tangible to show there. But a lot of other things which we are doing in the background where work has started, but something tangible has not come as yet because it will take some time for it to come. As I think in every presentation we clarified to you that a lot of these things take 12, 18, 24 months. We can show something tangible, which is working well. So ask the second level question, which is the bank doing things of this nature? Third is, does the bank have the management team and the bandwidth to be able to do that? And then fourth, I know you're beating us up on Citi acquisition and the risks attached to Citi acquisition. Yes, it is a largish acquisition in terms of the price which you're paying. 3,200 odd people, 45, 50,000 crores of deposits, 28,000 crores of assets. Is it that difficult? I would say the biggest risk there would be technology and just ensuring that the customer experience is smooth. But I have analysts here who are saying that they have an account with Citibank and they want to shift to Axis even before the transition happens. Because as they experience Axis, we believe very strongly that most of the customers not only stay, they will actually transfer more balances to us over a period of time. Now, obviously, it means better execution. It means that we have to ensure that the customer journeys are taken care of, the customer transition is very seamless. But is the confidence there? Yes, confidence is there. Will there be problems? Yes, there will be problems. We know there will be problems. But can we go and stand in front of the customer and say, we'll tackle it, we'll sort it out? Yeah, we are quite confident. So ask yourself these questions and hopefully the answers will be the right, at least the answers we want you to have.
Thank you, sir.
Yeah, hi. I have a few questions.
All are directed to me or should I give the others also here?
No,
Okay.
to the team. Yes.
Okay.
So basically, in terms of employee turnover, obviously the top management seems to have stabilized. You have a stable team. How is it behaving in the middle and lower levels?
Okay. The attrition rate in the industry in general has gone up post, Omicron or whatever, and it has gone up quite rapidly, especially on the front end. It is hovering anywhere, depending on how you look at the data, it is anywhere between 35 to 50%. Our number is slightly, I would say, less than the average in terms of the numbers, but it is for the top 4 or 5 banks, that's where it is hovering. If you look at the rest of the staff, it is hovering somewhere between 20 to 25%. And that's the data, anecdotal data we have. We don't have exact data because no one publishes it. So attrition has gone up. If you look at the transition and the transformation journey we are going through, and I will ask others to add if they want to add, I very strongly believe that not only the management team, but up to a level of EVP, which is a pretty large population, I think the alignment in terms of what we are thinking, what we are doing, why we are doing, what our journey is, how will we get there, what are all the projects at play, I think it's quite well aligned. At the junior level, the attrition is high. They are the first ones to align. They are the least of the problems. I'm not saying that the alignment is not important, but they align pretty quickly based on the signals they get from people above. It's the middle management. And yes, the middle management is still work in process. I'm not saying it is all done. But as they see the impact of some of the changes which you brought about coming through slowly, gradually, as our results continue to hopefully meet expectations of all of you, I think that transition will also happen faster than I thought, but that is still a work in process. I don't know whether anyone wants to add to, I guess they're okay with my answer.
Okay, my next question is that you've talked about sustainability and probably, moving down on the cost to asset ratio. But just in terms of margins, are they sustainable or they can improve from here on? Because other banks, given the cycle, are pointing to even further margin expansion. Though, of course, your margins have behaved very well and there's been a lot of positive traction in the last one quarter.
So, Puneet, what is the exact word? Sorry. I'll be careful here.
So, Mahrukh, I think the way we were requested to think about margins is depending on choices franchises have made with respect to how they reprice loans given the repo rate increase, the margins would have a lead lag effect. What we're simply saying is we've reached a margin level that is higher than what we had structurally said we would be at. We are saying deposit cost will increase in quarter 4 given the size and scale of our franchise. But we've also shown you the structural levers which we report on every quarter. We think our structural levers still have legs left. Therefore, there will be a push on margins by virtue of deposit cost increase, but we have levers to offset them. We are in a zone for the risk calibration of the book that we run. We are not really giving you a directional guidance on whether margins will move up or move down. We're just saying our structural levers have enough legs for us to create offsets to deposit cost increases as we stand today.
Okay. Thank you. Thanks a lot.
Hi, this is Abhishek from HSBC. So, couple of questions. The first is on loan mix, and when you look at PLCC, business banking, and rural, those 4 segments, how much higher can they go from here? They're already, I think, around mid-20s put together. How much higher can it go from here as a part of the whole book?
So, Abhishek, what we've said is that on the retail unsecured side, last year we had a front book which is disbursements which were 86-14 at peak COVID. Last quarter we got to 26-74 on flow, but on stock we are still at 80-20. 80% secured, 20% unsecured. I'll come to. So on the retail side, we will maintain a range that we've called out to be within a 25-75 on the retail side. To your question on mid corporates plus SBB plus CBG growing in percentage terms, the 14 that went to 20, directionally we are focused on moving that number up because that is a core segment and we've said our core segments will grow faster than the rest of the book.
But what will be a ceiling or a target level beyond which you will say that, okay, now the risk will be too much and we need to calibrate the growth?
So Abhishek, I want to clarify upfront that this is not a risk choice. We showed you some outcomes on what risk we are undertaking. So the choice, first and foremost, all of our underwriting decisions are to deliver risk-adjusted growth. So RAROC is the framework that we use. Amitabh did indicate that through cycle we don't expect credit costs to be where they are today, but net of whatever through cycle credit costs we land at, the margin expansion net of credit cost should be positive. And that's how we structure the book. And therefore, we don't need to have artificial ceilings on where we would want that book to land at.
Sure. And the second...
Just also appreciate that the reason why the number has also partly gone up is because the wholesale book has not grown that much. Once hopefully that growth comes back, I'm sure the book will grow, but maybe not at the same pace as what you see.
Sure, thanks. The second one is on costs and just trying to get a direction. I know you've said 2% in FY25 exit. And you also, through the day you showed that a lot of projects are 60-70% complete and now they should actually start bearing fruit in terms of productivity or efficiency gains. So when do we really start seeing cost to assets turn around? It may be 2 quarters, 3 quarters, but when does it start coming off and moving towards that 2% target?
So Abhishek, what we showed you were projects, like Amitabh said in a previous response, projects that have started showing early results for us. We have projects under the surface that we continue to make investments in. We feel confident that given where the credit cycle is, we'd like to continue to make investments to take the franchise and the projects to a sustainable level. So we will continue to make investments. We do expect productivity of existing projects to start delivering through. And the call out that we have is we will get you to around 2% by FY25. An intermediate call out, if you want directionally, when will the curve turn? I will simply guide you to how I think about cost. You've seen cost growth flatten. You've seen cost to income improve. Cost to assets will come through because when I start growing my wholesale book, when it gives me the appropriate RAROC, I'll get a denominator kicker. My segmental reporting shows you cost to assets for wholesale is meaningfully lower than where I am. And a large part of my growth today has come from retail, which is what is giving us the confidence that we should get to the 2%, around 2% number that we are indicating.
Sure. Thank you.
Yeah, please go ahead.
My question is around over past few years, Axis Bank and in general the other private banks have maintained a very healthy growth rate and growing higher than the system. And PSU banks have been losing. But now the PSU banks' loan book is also equally clean. They are also scouting for growth. So will it be as easy for private banks now to maintain this growth trajectory over the system?
So when you look and pass through the public sector bank data, they're growing into a couple of areas. One is that they're growing their wholesale book quite rapidly, which is hopefully to the right quality corporates on the wholesale side, both domestic and foreign. And they also entered the mortgage space in a big way because they believe they have security and they can do that well. We are not seeing, they were always present on the SME side of the business, but a lot of the SME side growth for at least the private sector banks is coming because you're winning that business from public sector units. So I don't know how well they're doing on the SME side. The definitions change, so sometimes it's difficult to look at the data and really decide what is happening there. So yes, while there is growth on the PSU side, it is only in very few identified segments. I think we also have to understand and appreciate as to what has really changed in the way some of these public sector banks are looking at what the future could be. And I would say while some of the one or two banks are really obviously doing a great job, a lot of the other public sector banks are still struggling through putting the basics in place. And that would mean that it will continue to give opportunities to the private sector banks to win market share from them and even NBFCs to win market share from them over a period of time if they don't get their act together quickly. So that's my view at least.
Right. Thanks. And the other question that I have is around the capital accrual that we have reported. Like over the first half, Axis has reported pretty modest growth versus the other private banks in the system. So while the capital accrual number does look very good, but how sustainable is this? And as now Axis looks to grow in the coming quarters and years, will we be looking at a very massive capital raise, especially after the Citi deal?
So thanks for the question, but if I cut the data at March 21 and showed you March 21 over September 22, the direction on the chart would not change. There would be a odd basis point change. So it is not convenient data that you saw on the left-hand panel of the chart saying we're getting self-sufficient. And between 21 to now, we've grown at an adequate pace. So that should give you some comfort. If you look at September 21 over September 22, our asset growth has been 18%. So we gave a financial year cutoff because all our numbers for competition on previous slides were as at March 22. So that's the reason. It's not coloring data. So I just want to clarify that for you. Happy for you to do the exercise, or we can take this. I'll show you the Excel offline. I have it with me. Okay, so that's the data point. On capital raise.
Only one question Puneet allowed me to answer on the financials. So we made quite a categorical statement, I think, recently that and on the call that we do not intend to raise any capital till the Citibank transaction is done. We are hoping to close the Citibank transaction as of March 1st. Now it could get delayed because a lot of technology elements still have to be delivered. And if it gets delayed, then we can't do it April 1st. We have to kind of postpone it by a couple of months because it is year end for us. And I think I'm sure it's a year end for them also. And it's very difficult to kind of do too many things at the same time. But it is in that zone and in that time frame. So assuming that transaction does happen in the March to May time frame, we will, even if we decide to raise capital, not that I'm suggesting for even a second that we're trying to raise capital after the transaction is done, we have to redo our data, we have to we've got to completely redo the data for Axis Bank because it include Citibank numbers, a lot of hard work required. Then we don't even have an approval in place, by the way, as of this point in time to go and raise capital. So even if we wanted to, it will take quite some time for beyond that. We are in a comfortable capital situation, but at the same time, we are very watchful of what is happening on the macro globally. And so we cannot just stand here and say, come what may, we will not raise capital because that will be the wrong thing to do. So are we intending to raise capital beyond the Citi transaction? Right now, if you were to ask me, we are watchful and we are watching the space. We are very clear, we did make it clear in the call that we will raise it at the right price. We are very cognizant of the fact that we don't want to dilute the existing shareholders. So we will wait to raise capital at the right price if we decide to raise capital post Citi transaction, assuming we are worried that the macro is not good or whatever. So I'm putting a lot of conditions there. I think that should give you enough color in terms of how our thought process is going.
Thanks, Amitabh.
Go ahead, Gaurav.
Yeah, Gaurav from Prabhudas. Firstly, on deposits, just had a question. Part of our performance probably is also because of what's been happening in the system. So, when do we actually see deposits kicking off in the system? I mean, how long would it take?
See, a lot of interactions have been happening with the RBI and the various banks also. I'm sure you read the reports about Governor himself doing meetings. I did not get a sense there that there is complete clarity in terms of when this will pick up. I think government has become smarter in spending money. Obviously, RBI has withdrawn liquidity from the system. The overall savings rate is down. A lot of people are investing more in mutual funds than before and stuff of that nature. So they're seeking yield, maybe in the right places, but they are seeking yield. So the overall deposit rate has come down. Is there a trigger I can see today that, oh, by the way, this trigger is coming and things will improve? Hopefully, when the private capex and the government capex starts happening in a big way, some of that should help. But I don't see anything happening in the next 2 to 3 quarters. If, assuming deposit growth does not happen for a reasonable long period of time, there is no choice in the system but to bring the asset growth down, because it's not sustainable. As simple as that. And at that time, the government and RBI will ask themselves the question, I hope, that, okay, what do we need to do to get the deposit growth to be back so that the credit growth in the system can be picked up. So let's see at that time what happens. And by the way, the reason credit growth is looking better also is because of the base effect. Let's not forget that.
Sure. Secondly, assuming deposit growth picks up in the next 2-3 quarters, could we sustainably look at a growth of about 18-20% since we've also raised our probably growth guidance?
We are not raising any guidance. We are just saying that we have put all these levers and platforms in place. Puneet had a chart there which very clearly said that we have promised to grow at a rate higher than that the industry growth rate, and whatever the industry growth rate is, whatever you just mentioned, hypothetically, then we will deliver a growth rate which is better than that over a medium to long term. It might not happen quarter on quarter, but in the medium to long term, we'll deliver a growth rate which is 5 to 6% or higher. We have said that openly.
Sure.
And we're not shying away from it.
Thanks.
Anybody? Any more questions? Okay. Go ahead, Jay.
Yeah, hi sir. This is Jay from BNK Securities. Question on cost again, but from cost to income perspective. So you had mentioned that you have come to a stage where most of the hard work on cost has already been done. Does this alternatively mean that at least cost to income has already peaked and it should start incrementally looking better?
Jay, thanks for the question. I think we've always said that we would look to continue to invest in the franchise given where the credit environment is, and we have projects under the surface that require investments. The cost income journey for us will be an income journey, which we have demonstrated, and cost to assets, like we said earlier, should normalize once we get the right risk adjusted return on capital growth for our wholesale segments.
And sir, just a last question on, so you had mentioned that Bharat Banking is one of your new or key growth driver. You have added 700 branches in the last 3 years. Now, as you go more aggressive on Bharat Banking, does that mean a relook at the branch expansion strategy? Also, given the fact that one of the larger peer is looking to double its branches, so any thoughts there? Thanks.
So it's not that we don't look at what others are doing. We do look at what others are doing. That does not mean we have to copy what they're doing. I think the Bharat Banking strategy is more than just opening branches. It is about expanding our presence in a very meaningful way in RUSU markets. And branch is not the only way to expand that presence. There are various ways to expand that presence, and that's precisely what we're trying to do. We will continue to open the branches, but because we're doing Bharat Banking does not mean that we're going to increase the pace of opening of our branches. I don't think we've made that statement. I can see tired faces. I don't want to, people who are asking questions should ask at their own peril, because others must be wondering, why are you keeping people, waiting? I can see that at the back, by the way. So, but anyway, last questions, very happy to. People are holding their book to just get up and go.
Any more questions?
See, now no one will ask. Okay.
No, good. No, thanks for the patience. We sort of exceeded a bit of the time, but thanks again. I think the time well spent. By the time you reach home or office, Nitin would have made sure that the PPTs are all uploaded. So you'll get that. We still have some of our kiosks out there. Anybody wants to sort of still do the account aggregator, we have sort of that kiosk open, and we also have in the entire management who presented today there to sort of have a chat. So thanks again. On our way, please collect the giveaway. We have it for you. And thanks again, and appreciate your time. Thank you.